Hello, and welcome back to The Unlearned Investor. I am your host, and this is episode 3 of our series, Investing with the Signal and the Noise. Today's episode, SpaceX IPO. Before we begin, the usual disclaimer: I am not a financial advisor. This podcast is for educational purposes only. Always do your own research and speak with a certified financial professional before making any investment decisions. Okay, let's get into it. The entire world is going absolutely crazy over the rumor of a SpaceX Initial Public Offering, or IPO. Financial headlines are treating it like the biggest event in market history. Mainstream media outlets are running constant calculations on how this valuation will officially make Elon Musk the world's first trillionaire. The hype is everywhere, and the temptation to get a piece of it is incredibly strong. But as retail investors, we have to separate the loud emotional media noise from the cold, data driven fundamental signals. Let's look at the numbers behind the buzz. Because SpaceX is a private company, it has zero legal obligation to share its financial performance with the public. What we know comes entirely from unverified media leaks and financial reports from outlets like Bloomberg. According to these leaks, SpaceX isn't just a rocket business. It is a conglomerate split into three distinct arms with projected numbers for the current cycle. First, space transport, the rockets. The high profile core that launches satellites has a rumored 2025 revenue of $4.1 billion, operating with a loss of roughly $657 million. Second, Starlink, the satellite internet. This is the real cash engine. It pulled in an estimated $11.4 billion in revenue, generating a $4.4 billion profit. This is currently the only profitable side of the company. Third, AI and infrastructure, the XAI and Grok data centers. Reports point to $3.2 billion in revenue, but with staggering infrastructure losses of $6.4 billion. If we total these numbers up, SpaceX is pulling in an estimated $18.7 billion in combined revenue. But here is the catch: this is unaudited private data. Before your gut convinces you to hunt down a way to buy into this hype, your brain needs to understand where this data comes from. None of these numbers are audited. None of them are verified by independent financial regulators. In the private markets, a company can present its numbers exactly how it wants to frame them. It is under no public standard of accountability. Basing your investment thesis on unverified numbers from a news article isn't a calculated risk, it is a pure gamble. Let's talk about what an IPO actually means. An IPO, or Initial Public Offering, is simply the moment a private company opens its doors to let the general public buy its shares for the first time. The financial industry markets an IPO as a special gift to the everyday investor, giving you a chance to buy in on the ground floor. In reality, an IPO is an exit strategy for early stage venture capitalists, institutional funds, and insiders. They have had their money locked up in a private club for a decade. The IPO is their payday. It is their prime opportunity to sell their private stakes to the public at the absolute highest price they can get. Because existing investors want to lock in peak profits, a company going public has every incentive to inflate its narrative, show aggressive projections, and achieve a sky high valuation multiple. To understand how inflated an IPO price can be, let's do a reality check using raw historical data. Let's look at transparent public firms with audited financials using their actual data as of today, May 28th, 2026. First, look at Alphabet or Google. They reported a massive $109.89 billion in total revenue for the first quarter of 2026. Their earnings per share, or EPS, sits at $5.11 with a target valuation market cap of $4.7 trillion. Their stock price per share is $390.13, giving them a price to sales multiple of 10.7 times. Next, look at Apple. They reported $143.8 billion in total revenue for the first quarter of 2026. Their earnings per share sits at $2.84. With a target valuation market cap of $4.59 trillion, their stock price per share is $312.51, giving them a price to sales multiple of 8.0 times. When you look at public giants like Alphabet and Apple, the math is clear. Alphabet generated an actual audited profit of $5.11 per share for the quarter, meaning its stock price is backed by cold hard cash. Apple cleared a reliable profit of $2.84 per share. Now, look at SpaceX. The rumors suggest the company is targeting a staggering $1.75 trillion valuation. If we take their estimated total revenue of $18.7 billion, you are being asked to pay a price to sales multiple of 93.5 times. Think about that. You would be paying a massive valuation premium for unverified, unaudited revenue from a loss making rocket and AI business, a premium that is vastly higher than what you would pay for the stable, multi billion dollar profit streams of Apple or Alphabet. There is no earnings per share here because the business is loss making overall. This is why you should wait and watch. Even if SpaceX is a great business, buying a stock on the day of its IPO is a massive gamble. The smartest move you can make as an investor is to practice delayed gratification. You do not need to be first. Once a company goes public, the legal game changes entirely. It is forced by law to release audited financial results every 3 months. The corporate walls become completely transparent. So, here is the playbook. First, ignore the initial adrenaline. Let the day one traders flip the stock. Let the early venture capitalists cash out their shares. Second, wait for equilibrium. Within 6 to 12 months, the media hype always dies down. The stock price and the underlying corporate earnings will naturally find their equilibrium in the open market. Third, look at the public records. Wait until the company has published 2 or 3 quarters of audited official numbers. Look at the real profit margins, the real debt metrics, and the real cash flows. An IPO is a single marketing event designed to maximize value for sellers, not buyers. Your real edge as a retail investor isn't speed, it is patience. Wait for the noise to clear, look for the actual signal in the verified math, and only deploy your capital when it shifts from a blind gamble into a calculated risk. If you've enjoyed this episode, please follow The Unlearned Investor on Spotify and subscribe on Substack at unlearnedinvestor.substack.com. See you and take care. Signing off, The Unlearned Investor.